You look at this week, I don't think any of us can remember an election where actually everyone was happy with the outcome. There was something to like for Democrats, Republicans, and from our point of view, especially for international investors, a very strong signal from the bond market yesterday by yields not racing higher like they normally do when you have the stock market as strong as it is. It's more than just the prospect of not expanding the budget deficit from additional tax cuts. It's de-risking in the minds of international investors the political situation. It's the whole checks and balances, whether that in fact turns out to be the case, but it's all supportive of the market.
I think the power of gridlock is a real thing too. And we always say, well, gridlock, the market's removal of uncertainty because you just don't like elections, and then nothing, no knockout blow on either side. So gridlock, which means whatever we did, whatever Trump did with tax reform or whatever the Republicans did with tax reform and deregulation is probably going to stay until the next election, at least.
And the reality is we're back to a point where, at least for the next few days or the next few hours, we can focus on the micro, and the micro is good. Earnings are good, the economy is good, and valuations are reasonable.
All right, James, I'm not understanding some of your terminology here, but I think you're using it in a different way, because you're saying that that we're in a late cycle, and Melissa watches sentiment a lot. So the wall of worry continues to build, compounded by market complacency. So that, to me, that makes no sense at all, because the wall of worry is usually a sign that there's not complacency, and that's usually good because the markets trade higher on a wall of worry. They climb the wall of worry, right? And then the complacency is when you worry about a market break because people are too confident in their position. So you're saying that the problem is we have both? So are you covering just all your bases? What does that mean? The wall of worry is building, but the complacency is building. How can you have both?
So it's not that the complacency is building. It's that investors were complacent, especially last year when the market just kept rising. And so, short term, the election was probably the best result that the markets could have asked for. It's exactly what was expected. Like you said, it reduces uncertainty. It still leaves the door open for some pro-growth policies, like potentially infrastructure spending, things like that. What we see, though, with that statement is that there is the biggest gap we've seen this cycle between short-term and long-term expectations. Short-term, I think we're all pretty happy with where the market is. Things are cheaper, getting at a better price point. Earnings are still really strong. Fundamentals look good. But longer-term, I mean, we are late cycle. I think there are very few people that disagree with that. And you look at what the Fed is doing. You look at where we are with unemployment. It's hard to see the cycle extending for several more years.
Are we really cheaper? I mean, right now we're back at levels from October 9th. So we're back to the levels where we basically sold off for the month of October. So can we actually say that we're cheaper, or do we have the same valuations as back then and all the same worries, except that the midterms are over?
Yeah, you're absolutely right, Melissa. We're not cheap. We're slightly cheaper, meaning we pulled back 9% and then we rebounded after October ended. But I think for most investors, the issue is simply, where should we be positioned from here? And so, you look at where the fundamentals are, and we still think being balanced both across equities and fixed income and internationally, which has taken a big hit this year, that's still probably the best play for most investors.